If you're a business owner making $150,000 or more in revenue, there's a very good chance you're overpaying your taxes by tens of thousands of dollars every single year. Today, I'm going to show you exactly why this happens and what you can do to stop it immediately. There's something that happens when your business revenue crosses the $150,000 mark. Your tax situation becomes fundamentally different, and the strategies that worked when you were making $50,000 or $100,000 just don't cut it anymore. But here's the problem. Most business owners keep doing the same thing. They keep working with the same accountant who's been handling their taxes since day one. They keep using the same business structure. They keep following the same approach. And because of that, they're leaving massive amounts of money on the table. The gap between what you're paying and what you should be paying gets wider and wider as your revenue grows, and unless someone tells you there's a better way, you'll never know how much you're losing. Reason number 1, wrong entity structure. Let's start with the biggest reason business owners at this revenue level overpay. They're using the wrong entity structure. When you're just starting out, being a sole proprietor or single-member LLC makes sense. It's simple, it's easy, and the tax burden is manageable. But once you're consistently making $150,000 or more, you need to be looking at an S-Corporation election. Here's why. As a sole proprietor or single-member LLC, you pay self-employment tax on all your profit. That's 15.3% for Social Security and Medicare on top of your regular income tax. So if you're making $200,000 in profit, you're paying over $30,000 in self-employment tax alone. But with an S-Corp, you split your income into two parts, salary and distributions. You pay yourself a reasonable salary, let's say $100,000, and the rest comes out as distributions. You pay payroll taxes on the $100,000 salary, but not on the distributions. That means instead of paying self-employment tax on $200,000, you're only paying it on $100,000. That's a savings of over $15,000 per year, and that's just from changing your entity structure. But most business owners don't know this. Their accountant never brought it up, or they think it's too complicated, so they keep overpaying year after year. Reason number 2, not maximizing deductions. The second reason is simple. You're not maximizing your deductions. At $150,000 or more in revenue, you should have a sophisticated approach to tracking and claiming every possible business expense. But most business owners are leaving money on the table in these areas. Home office. If you're working from home, even part-time, you should be taking the home office deduction. This includes a portion of your rent or mortgage, utilities, insurance, and maintenance. Vehicle expenses. Every business mile should be tracked and deducted. Whether you use the standard mileage rate or actual expenses, this adds up to thousands per year. Technology and equipment. All your software subscriptions, computers, phones, and equipment are deductible. Did you buy a new laptop? Deduct it. Paying for cloud storage? Deduct it. Professional development, courses, coaching, certifications, books, conferences. If it's helping you grow your business, it's deductible. Travel. Business travel, including flights, hotels, meals, and transportation, is all deductible if it's for business purposes. Outsourced services, freelancers, virtual assistants, contractors, legal fees, accounting fees, all deductible. The problem is, if you're not tracking these expenses properly throughout the year, they don't get claimed. Your accountant can only deduct what you give them, and if you're not organized, you're missing out. Reason number 3, missing tax credits. Now let's talk about tax credits because this is where serious money gets left behind. Tax credits are different from deductions. A deduction reduces your taxable income. A credit reduces your actual tax bill dollar for dollar. So a $10,000 credit saves you $10,000 in taxes. It's incredibly valuable. But most business owners at the $150,000 level or more have no idea what credits they qualify for. R&D tax credits. This is the big one. If you're developing new processes, improving systems, creating proprietary methods, or innovating in any way, you might qualify for R&D credits. People think this is only for tech companies, but it's not. Manufacturers, consultants, agencies, software businesses, tons of industries qualify. These credits can be worth $10,000, $20,000, $50,000 or more, depending on your spending and activities. Work opportunity tax credits. If you've hired employees from certain groups, veterans, ex-felons, people receiving government assistance, you can get credits for each hire. Health insurance credits. If you're providing health insurance to employees, there may be credits available depending on your size and structure. Energy credits. Made energy-efficient improvements to your business property? There are credits for that. The problem is, your accountant has to actively look for these. They have to ask the right questions. They have to understand your business operations. If they're just filing a basic return based on the numbers you give them, they're missing these credits. Reason number 4, no proactive tax planning. Here's the 4th reason, and this one ties everything together. You're not doing proactive tax planning. Most business owners only talk to their accountant once a year, right around tax time. They hand over their documents, the accountant files the return, and that's it. But by the time you're filing your taxes, it's too late to implement any strategies. Everything that happened in that year is locked in. You can't retroactively change your entity structure, maximize retirement contributions, or restructure how you took income. Proactive tax planning means meeting with a tax strategist throughout the year. It means making decisions in January, June, October that will reduce your tax burden when April rolls around. It means asking questions like, should I make a big equipment purchase this year or next to optimize depreciation? How much should I be contributing to retirement accounts? Should I be paying my spouse or kids through the business? Are there opportunities to defer income or accelerate expenses? These decisions save you tens of thousands of dollars, but only if you're planning ahead. How to stop overpaying? Step 1. Get a tax strategy review. Have someone who specializes in proactive planning look at your entire situation, your entity structure, your deductions, your credits, your business operations. Step 2. Optimize your entity structure. If you're not an S-Corp and you should be, make the election. This alone can save you $10,000 to $20,000 per year. Step 3. Implement a system for tracking expenses. Use accounting software, keep receipts, categorize everything properly so you're not missing deductions. Step 4. Work with a tax strategist year-round, not just at tax time. Make this a partnership where you're actively planning to minimize taxes, not just reacting after the fact. Step 5. Review past years. If you've been overpaying, you can amend returns going back 3 years and get refunds. The cost of inaction. Let me put this in perspective. If you're making $200,000 in revenue and you're overpaying by $20,000 per year because you're not optimized, that's $20,000 that could be reinvested in your business, saved for retirement, or put in your pocket. Over 5 years, that's $100,000. Over 10 years, $200,000. That's the real cost of not having a strategic approach to your taxes. If you're making $150,000 or more and you've never had a strategic tax review, visit our website and book a free call with one of our tax strategists. We'll show you exactly where you're overpaying and how to fix it. Thanks for watching, and I'll see you in the next one.